Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Thank you for joining me for this month's market update. As we move through the quarter, I want to take this time to highlight some significant changes we're seeing in the markets. While the headline levels don't show it, there's a big shift in leadership happening beneath the surface. Its impact goes across sectors and a much more differentiated market within technology specifically. In the next few minutes, I'll walk through the key data that captures these shifts, what's rotating, what's holding up, and what the macro and credit backdrop are signaling as we wrap up a strong earnings season. Let's start with the year-to-date scorecard across the major indices. I'm showing here the S&P 500, NASDAQ, the Dow Industrials Average, and two international indices. The MSCI EAFE Index, which represents more developed companies outside the US, and the MSCI Emerging Markets Index. What stands out immediately is the strength in international, which has picked up throughout the quarter here, helped in part due to a further weakening dollar, which has boosted these returns. But if we focus in on just the US indices, the S&P 500, NASDAQ, and the Dow, there has been an enormous shift away from tech, and specifically the software space, in favor of more industrial and infrastructure-based trades. As advancements in AI continue to accelerate, high-margin software companies have found themselves in the crosshairs, as investors view those margins may be at risk. That's because these new AI tools are making it easier for both individuals and businesses to build competing products at almost no cost. On the other end, the Dow, which is less concentrated in mega-cap growth, has been pretty resilient. And you may have even heard it broke above 50,000 for a bit this month. And while this rotation is significant, it doesn't mean US large cap growth is broken. What it does suggest is that performance is becoming more distributed across different parts of the equity market. That's happening both within the US and globally. And when you see that kind of diversification in returns, it tends to be a healthier setup than a market that depends on a very small number of stocks doing all the work. The next chart gets right to the heart of the breadth question. This highlights the market cap weighted S&P 500, where larger businesses are a higher percentage of the index, versus the equal weight S&P, which is just how it sounds, an index where all 500 companies are held at the same percentage. This means a company like Microsoft, which has a $3 trillion market cap, counts for the same weight as Campbell Soup does at just $8 billion. It's just another way to look at some of these market dynamics. So for much of the past 2 years, the cap-weighted S&P 500 significantly outperformed the equal weight version. That told us the rally was highly concentrated. The largest companies were driving a disproportionate share of index returns. Now more recently, that gap has begun to narrow. And you can see here, the equal weight index has significantly outperformed so far in 2026. Now it's early days, but that's an important signal. When the equal weight index starts to pick up, it means the participation is improving beneath the surface. More companies are contributing to performance rather than a narrow subset at the top. This certainly doesn't guarantee smoother markets week to week, but it does tend to be a healthier structure over time. Broader leadership generally reduces fragility and concentration risk, as well as signaling investor confidence in the overall economy. If we turn to look a little deeper at the sector level, you can see the rotation more clearly. In 2025, technology and communication services carried an outsized share of the market's gains, especially the largest platform and AI-levered names. Year to date, leadership has shifted. Those higher octane companies have pulled back, and we've seen more consistent contributions from sectors like energy, consumer staples, and industrials. And in periods where the market has been choppy, some of these areas have provided better balance than the higher beta growth names. The key point is that this isn't a wholesale unwind of technology. I would view it more as a rebalancing of leadership. We aren't seeing investors fleeing risk, it's a rotation of risk-taking, rather than rolling over or heading for the exits. Staying within technology, the next chart highlights a major split that matters for positioning. Software versus semiconductors and hardware. Over the last year, semis and infrastructure-linked areas have continued to lead. supported by ongoing spending on data centers, chips, and power build-out to fuel the AI boom. Some of these individual names are now approaching dizzying heights. And on the other hand, I mentioned software, and especially parts of the SaaS universe, that have sold off considerably year to date. That divergence is pretty shocking when you see it laid out on here. It suggests the market is still comfortable underwriting the infrastructure build, where spending is visible and near-term demand remains incredibly strong, but it's becoming more selective about the application layer. We still need more clarity about the long-term impacts AI will have on these software businesses. But for now, investors are just willing to step aside. That might create some opportunities in names that have staying power, but there's a risk of trying to catch a falling knife here as well. Moving on now, let's zoom out to the macro backdrop, as we received some new data in the last couple of weeks showing the inflation picture remains constructive. But the composition is important. I'm breaking out on here inflation measures for both services and goods. You can see that services inflation continues to decelerate from those post-COVID highs. And while it's still considered the stickier component, the trend has been moving in the right direction. Goods inflation, on the other hand, has picked up modestly after the tariffs were put in place last year. It's not a surge, but definitely enough to show up in the data. The takeaway is that inflation isn't re-accelerating in some broad, destabilizing way. This looks more like a normalization process, with different components moving at different speeds, rather than a renewed inflation shock. And that matters because when inflation is manageable and policy expectations are not constantly being repriced, then investors are more willing to reallocate within equities instead of de-risking altogether. Finally, let's take a look at credit spreads. While equity markets are broadly positive, these are a useful check on whether markets are quietly pricing in recession risk. High-yield spreads remain historically low and well contained. They're not behaving like a market preparing for a credit event or an imminent downturn. That doesn't mean risk is absent. Credit can reprice quickly and often does. But right now, spreads are consistent with a stable growth backdrop and functioning liquidity. In other words, this rotation we're seeing in equities looks more like a repositioning within risk assets than a broad move away from risk. So what does this mean for portfolios? First, we don't view this as an environment that calls for materially reducing equity exposure. Broadening participation often extends market cycles. It doesn't usually end them. Second, it reinforces the importance of managing concentration. The last few years rewarded exposure to a narrow group of mega-cap winners. If leadership continues to broaden, then diversification within equities, across sectors, styles, and even geographies, becomes more valuable. Third, as the market shifts from multiple expansion toward fundamentals, earnings quality matters more. Cash flow durability, pricing power, and balance sheet strength tend to be rewarded when the market becomes more selective. And finally, within innovation themes like AI, selectivity really matters. The infrastructure side of the trade has been clear. The application side is moving into an execution phase, and markets are pricing for that in real time. To summarize, the most important development this month is that leadership is becoming more distributed. That's typically a constructive signal for markets, especially with inflation trending in the right direction and credit markets remaining well-behaved. As always, we stay disciplined, diversified, and focused on long-term outcomes rather than short-term noise. Thank you for listening, and we'll speak again next month.